This is Macro Horizons, episode 347, Best of 1993, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of October 27th. With a nod to our trick-or-treating plans on Friday, we'll welcome the opportunity to dust off our DVD of Tim Burton's The Nightmare Before Christmas. Apparently, Washington is in the process of making a sequel with an equally dystopian outcome. Don Skellington, perhaps? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most relevant new information obviously came in the form of the September CPI release. Here, we saw that headline CPI increased just 0.3% in the month of September compared to expectations for a 0.4% gain. Keep in mind that August also increased 0.4%. As a result, the year-over-year pace ticked slightly higher to 3.0% compared to the 2.9% prior. However, it did underperform the 3.1% consensus. More importantly, the core inflation series saw a benign 0.2% increase for the month of September. On an unrounded basis, that was 0.227, so we'll characterize it as a solid 0.2 compared to the 0.3 consensus. Within the details, the core CPI services, excluding OER and rent, increased 0.35%, which was effectively the same as the 0.33% in the prior month. Core goods came in at just 0.22% on a month-over-month basis for September, and that was a downtick from August's pace of 0.28%. The punchline of the core goods figures is that we are not seeing significant tariff pass-through to core goods. At least not yet. Perhaps just as importantly is the fact that we are now through the September series and we haven't seen the major reflationary impulse that many had feared would follow the trade war. Now, to some extent, we know that part of the story is that producers and retailers are not passing along the entirety of the tariffs to the end user, instead choosing to absorb some of it via profitability. Now, the extent to which this can extend through the holiday season is a wild card to be sure, but so is the data schedule, because as it currently stands, the federal government remains closed. We are biased for this particular government shutdown to set a record, as it were, which would put the opening later than November 5th. Now, the logic here is relatively straightforward. We haven't seen any significant movements on the political side, which would suggest that there's a reopening in the offing anytime soon. That being said, by the time we get to the 5th of November, there should be sufficient mounting political pressures on both sides to reopen the government. In light of the fact that we're operating on the assumption that the government is reopened sometime in mid-November, that implies that the economic data for October as well as November will be distorted by the shutdown. In practical terms, it probably won't be until the December data series, which is released in January, that the market has a more comprehensive understanding of the broader performance of the real economy during the fourth quarter. Translating this to monetary policy expectations, this corresponds with a 25 basis point rate cut in the week ahead, and presumably one that could be characterized as a dovish cut. We also suspect that the September data cements a 25 basis point rate cut in December as well, and also puts both January and March of 2026 decidedly on the table for 25 basis point rate cuts. Returning to the data for a quick moment, We will highlight that OER, or owner's equivalent rent, for the month of September was a very benign 0.135%. This has been a closely watched series, as throughout much of the post-pandemic experience, housing inflation has been a pillar to the core series. Now that we have both benign housing as well as goods and service inflation, the Fed's path is now clear to continue normalization, and it follows intuitively that the Treasury market has traded this accordingly as a bull steepener, with the 2-year sector outperforming, although nominal rates falling further out the curve as well. We now see 10-year yields drifting comfortably below 4%, and we continue to expect that 3 handles will replace 4 handles for the foreseeable future in benchmark 10s.
Well, Ian, I am thrilled to say, for the first time in a long time, we have economic data to discuss. September's CPI report came in softer than expected at just 0.2% versus the 0.3 consensus on the core measure month over month, and notably within the details of the inflation report, OER was up just 0.14% on a month over month basis. And that was enough to finally trigger a fundamentally driven response in the Treasury market, with yields dropping and the curve steepening, at least in the knee-jerk reaction to Friday morning's inflation update. Now, naturally, it didn't take long for caveats around data quality and data collection relating to the government shutdown to make the rounds and moderate the extremes of the move. And now, for better or worse, we'll probably argue more toward the latter. The government shutdown continues, and the market is re-entering the data void ahead of the final week of October and next week's FOMC meeting.
In addition to Halloween, investors will be looking forward to Powell's press conference. It goes without saying at this point that the market is anticipating a 25 basis point rate cut on Wednesday, and that should be accompanied by a relatively dovish FOMC statement. It will be interesting to see if there are any dissents in favor of 50 basis points, Mirren. And it will also be interesting to see how Powell chooses to characterize monetary policy into the end of the year. Recall that at the September press conference, Powell was quick to emphasize that decisions were being made on a meeting-by-meeting basis, suggesting that another rate cut in October or December was not a foregone conclusion. Fast forward to Wednesday, October is clearly a foregone conclusion, and we'll argue that so is December at this point. Now, that won't prevent Powell from trying to retain at least a degree of flexibility going into the December 10th meeting, but perhaps what will be even more interesting will be whether or not the Fed chooses to signal the end of QT and whether or not there are fine-tuning adjustments to interest on reserve balances and the repo facility. All else being equal, we don't see the immediate need for such adjustments. However, if the Fed wants to get in front of any potential year-end funding strain, it follows intuitively that a late October announcement would ensure against funding stress more than an early December one.
And beyond just the question of whether or not the $5 billion a month in SOMA roll-off will in fact be coming to an end in the near term, another leg of the balance sheet conversation, in addition to the potential tweaks to the Fed's administered rates, is whether or not we're going to start to see a more active participation by the Fed in the bill market. The first such potential action, and one that we expect is ultimately going to come to pass, although there's an open debate on the timing, is the reinvestment of the Fed's MBS portfolio into bills. This will add an additional calming effect to money markets, and given the longer-term conversation the Fed has been having around wanting its balance sheet to hold more bills, and if it's going to be a monetary policy tool, more closely mirror overnight rates, then SOMA holding more bills follows intuitively. We've also heard the idea offered that reserves have run down to a point that will necessitate, sooner rather than later, a return of reserve management purchases, akin to late 2019, as a way for the Fed to buy more bills and increase the amount of cash in the system. Now, it's certainly an open question when and how much the Fed would ultimately be buying in the very front end of the curve, but given the fact that we've already had the discussion around how bill purchases differ from a pure QE program, this issue promises to remain topical into the end of the year, regardless of what we learn about the balance sheet next week, and as the December meeting approaches, and investors keep a sharp eye on funding rates into the end of the year.
It's also an environment in which the mounting list of uncertainties created by both the ongoing trade war as well as now the ongoing government shutdown really leave investors nervous about the next potential leg on the macro side. Conversations about a more material slowdown in consumption remain topical, although the lack of official data does make it difficult for investors to gauge the degree to which there might be stress and strain on the side of the consumer. Obviously, the record high or near record high equity valuations have continued to contribute to the wealth effect. And putting this in the context of 10% of households driving 50% of consumption, we're certainly sympathetic to the idea that it will be difficult to derail the expansion in terms of aggregate data, even though the bottom two quartiles of U.S. households continue to show signs of stress. While eventually it will come down to whether or not the labor market is able to maintain a steady state, not too many hirings, not too many firings, or if there's another meaningful uptick in the unemployment rate, that will likely contribute to both consumer confidence as well as a willingness to spend as the holiday season comes into focus. Translating this all into a trading bias, we continue to like the bull steepener. However, of the steepener versus bullish aspect of it, our higher conviction comes down on the bullish side of the story. 10-year yields above 4% will continue to represent a buying opportunity. We're holding our year-end call for 10-year rates to reach 3.85, and in light of the CPI number, as well as the ongoing government shutdown, we'd be biased to revise that number lower, not higher, all things considered.
And in client conversations following the CPI report, despite the overall lack of data, the fact of the matter is that the details of the inflation print really did not change much from a broader point of view. After all, even before the government shutdown, we heard from the Fed that progress in bringing inflation closer to 2% had already reached the point that the Fed was comfortable resuming normalization, had already provided enough evidence that monetary policy was in fact restrictive, and even if it's extremely unlikely that we're going to hear any discussion around revising the 2% inflation target, for all intents and purposes at the present moment, the dual mandate has been distilled down to a single mandate and a single focus on the labor market. 2% core inflation is up to interpretation based on how it's calculated, and we'll get there eventually at some point off in the distance. But in the interim, the softness we've seen in the pace of hiring, headlines concerning layoffs, and the employment metrics that we do still have access to, ADP comes to mind, all paint a concerning enough picture on the jobs front that the bar for any inflation read to derail the easing bias or really trigger a rethink about the new downward trajectory in policy rates is very, very high. And at this point, we'd argue a 50 basis point cut at some point in the next several quarters is maybe more likely than a return to a data-dependent pause regime.
And it's also worth noting that the real debate at this point is whether or not January and March are truly live meetings. Both are priced in at better than even odds of rate cuts, and we think that that's fair given the information that we have. However, that's not to suggest that the information flow won't change once the government reopens and we have a better idea of what's going on the labor side. It's also worth noting that we will still have the October ADP figures in early November, and that will help level set expectations for how the real economy is performing. And in the event of another disappointing print, I think not only will that reinforce the December rate cut story, but it will also contribute solidly to the case for January and or March. Now, while there have been plenty of tradable headlines coming out of Washington recently, it's notable that the process of announcing Powell's replacement has taken on a slower cadence with less urgency. As Besant recently noted, Powell's replacement will likely be announced sometime after Thanksgiving before the holiday recess. This is very much in keeping with the traditional timeline for replacing the Fed chair, and if nothing else, it does take away the risk of a quote-unquote shadow Fed that the market chooses to emphasize over Powell's messaging. The data has conformed with the Fed's resumption of normalization, so from a Fed credibility perspective, the data has afforded Powell the cover, if nothing else, to shift monetary policy in the direction that the administration would have liked to see without clearly giving in to political pressure. Now, we're certainly cognizant of the arguments on either side of the debate, but at the end of the day, we'll suggest that the Fed has done a very good job in preserving as much independence as possible while responding to the realities of the economic data.
And looking ahead to next week, let's not forget we will have some important market events that are not impeded by the lights remaining off in Washington, and that is the 2, 5, and 7-year auctions. That will be the final coupon offerings before we get November's refunding announcement. Along with the shadow Fed chair discussions, the supply-driven bearish argument has also faded significantly from the macro discussion, and frankly, looking at the strength of the 20-year auction this past week, we continue to lean on the adage that auctions will bring out buyers. It was especially telling to see the strength of 20s, despite the fact that 20-year yields are effectively the lowest they've been on any sustainable basis in several years, and when taken in aggregate with the rest of the auction results we've seen so far this year, we're certainly less concerned that we're at the precipice of reaching a saturation point in terms of Treasury supply. Along with the nuances around the potential settlement changes and the other lines of questioning that were offered in the primary dealer questionnaire, we're also going to be eager to see any more formal communication from the Treasury Department around just how large a share of the overall market bills are going to occupy, given that Bessent has made it very clear he doesn't want to increase long-end coupon auction sizes anytime soon. And we can't help but give a nod to the coincidence of the fact that the Fed is maybe going to start buying bills for reserve management purposes right around the time the Treasury Department is going to more formally start leaning on the shortest part of the curve to fund the deficit. Is it MMT? Not really, but it's also not really.
I'm personally looking forward to the Doge caps being replaced by the MMT caps in the White House.
Just trying to make Soma great again.
Like it was ever not great. In the week ahead, the Treasury market will be focused on the FOMC decision on Wednesday. With the September CPI data now in hand, expectations have cemented on a 25 basis point rate cut, the tone of which will be notable. Whether it comes in as a hawkish or dovish cut to some extent remains to be seen, although expectations for a continued dearth of information in the coming weeks at least have reinforced the notion that while the Fed might want to retain flexibility regarding a December rate cut, at the end of the day, the path of least resistance will continue to favor expectations for further normalization. Now, there's clearly an ongoing debate as to where the Fed's rate cutting process ultimately ends, but our operating assumption is somewhere between 3 and 3.25, unless proven otherwise by the economic data, which, for the time being, will remain conspicuously absent. Recall that while BLS staffers were brought in to compile the September CPI print, they didn't do the data collection efforts for the October numbers. So once the government is once again back online, it will clearly take some time for the information to be collected, and perhaps more importantly, the combination of the October and November data sets will presumably be distorted enough by the government shutdown to reduce any informational value offered by the reports. Now, the same might be said about the October and November payrolls prints, although once we have September in hand, we'll at least have a reasonable departure point for the fourth quarter. There's also a few other open questions regarding the Fed, specifically whether the stresses seen in the funding market will warrant an extra 5 basis point reduction in the rate of interest on reserve balances and the standing repo facility. All else being equal, such fine-tuning adjustments to policy rates will not be a broader market event, although in the event that the Fed is concerned about year-end funding stress, an October announcement would seem to be reasonable timing. A similar argument can be made about the end of QT, and while we don't see any urgency for the Fed to announce the end of QT on Wednesday, we're certainly open to the possibility, and if that doesn't come to fruition in the week ahead, we'll have it penciled in for the December meeting. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And in keeping with the holiday spirit, we'll offer our top Halloween jokes. Number 1. Why didn't the zombie cross the road? Just didn't have the guts. Number 2. What animal is best at baseball? A bat. Or maybe a blue jay. Number 3. What does the bond market have in common with Halloween? The maturities may vary, but all are welcome to participate. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.